following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today for the show. We got some great topics for you today. Last week we started talking about the Taxpayer Advocate report to Congress, Nina Olson, and we're going to continue with that theme. But before I do, I want to talk a little bit about the investing climate in general and some of the things happening in the stock market. Before I do, let's give out the phone number here. The number for the show is 252-633-0107. We always welcome calls from our viewers and listeners. Our email is allthingsmoney@dlblain.com, and the website is www.dlblain.com. There you'll find information about myself, the show, as well as archive copies of the show. And as you know, we're broadcast on 94.1 FM WNBU in the evenings and cable TV 10 in New Bern several times during the week as well as on the weekend. If you miss a show, head on over to the website. You can download it there. Okay, so this week is kind of a monumental week in that most of the U.S. market averages have hit new highs not seen since October of 2007. That's right, the S&P 500, the Dow, they're achieving highs not seen since 2007, over 5 years. And so it's been quite a run from the peak in October of 2007 to the depths of the market in March of 2009 when people felt like the world was imploding and the markets were collapsing. And now here we are today hitting new highs. And so the question becomes, there's a lot of talk out there that the people that are bearish are basically gone. I mean, there's hardly anybody that's bearish anymore. People are becoming more and more optimistic. What they call the mom and pop investors seem to be returning. And you get a lot of talk about this great rotation from cash and bonds into stocks, people just pouring money into the fixed income market and keeping a lot of cash reserves and rotating into stocks. And I thought I would just comment a few things about that because there seems to be this misperception of this rotation and people rotating from stocks to bonds to cash and things like that. You hear topics like people are underinvested in stocks or overinvested in bonds. And when they say that, they're missing the fundamental point. And I want to make this clear to you. When you're listening to the media, when you're reading a paper, I want you to look at this stuff with a critical eye. And when someone says there's a rotation from cash into stocks, well, if someone has cash and they want to buy a stock, the person that owns the stock, what do they end up when they sell the stock? They end up with cash. And so this mythical rotation of cash into stock is somewhat of a fallacy. The level in aggregate of bond and stock investments is dictated simply by how many are available. Now, if you have a lot of money chasing stocks, it will drive the price up. But I want to dispel this notion that if there's all this money on the sidelines, that somehow it's going to rotate into stocks. There's a finite supply of stocks. Well, it's not finite. There can be new issues of stocks. So that's what you look at when you look at asset classes, whether it be stock or bond, is you look at the new issues. And so when we look at this rotation into bonds the past few years, what you've got to realize is that government debt has basically doubled since 2007. Yeah, I just want to make sure that the volume of U.S. government debt has doubled since 2007. And so this money pouring into bonds, so to speak, is simply buying what's being issued, where there's not been a lot of new stock issued for people to put money into. And so it's a fine distinction, but a distinction nonetheless, that if people have money sitting in a checking account and they go out and they buy a stock, now the person they bought the stock from has money sitting in their brokerage account. And then if they go buy another stock, then that person has cash. And so this notion that people are rotating into stocks or rotating into bonds is simply false. That the market in aggregate is an aggregate of everybody buying and selling, and the aggregate level of stocks issued by companies, either new companies or old companies issuing more stock, or debt, a lot of debt. And so we see this large allocation that is out there globally in terms of debt, and it's simply because there's so much debt right now that every time the Treasury has an auction of Treasury bonds, people buy it. And so that's new Treasuries that are out there. So it wasn't necessarily people selling stock and putting it into Treasury, because remember, that person sold the stock, they still have the money, it went into cash or bonds. And so it's just this fine distinction and illusion that I'd like you to think about, because you hear a lot of this talk of Wall Street, these rotations and moving cash into the market and things like that. And if too much money is chasing stocks, it certainly can drive the price higher. But I want you to forget is when somebody buys stock with cash, the person that sold it now has the cash. And so you didn't create more cash. The cash level is still the same after someone bought or sold. Now you can have margin. People can buy on margin, and that's where they're buying with lower cash amounts than is required. So if the stock is a $100 stock and they only have to put up $50 to buy it, so that can lead to some discrepancies. But for all intents and purposes, someone selling the stock and buying the stock, there's no cash moved into the market. It simply went from one person's brokerage account to the other person's. Okay. So anyway, the point is, after we've had this bear market and market valuation is somewhat lofty now people are starting to talk about, well, I'm going to get back in the market now, and that now is somewhat of a dangerous time. And this is why you have to have a plan, you have to have a strategic allocation so that you don't get whipsawed into these emotional decisions of putting money in the market or getting out of the market. But we're seeing it now. We're seeing people that are they see the market going up and they're wanting to invest in the market just as things are peaking out. Now, we don't advocate, timing the market, but, if you just inherited $1 million or something, I'd be very cautious about dumping it all into the stock market. You want to have a well thought out, reasonable assumptions for investment returns and come up with some sort of investment policy that will guide you, and you're not putting money in based on emotional decisions. Well, that's bringing us up to our first break. We'll wrap this topic up a little bit about what's going on in the market and how not to get caught up in some of the emotional traps of investing, and then we'll move on to talk a little bit more about the IRS. So for All Things Money, I'm your host, David Blain. We'll be right back and for a few short messages.